Hi, Sam Volkering here with you, and I am joined once again by John Ciampaglia. Thank you, John, for joining us. John is the CEO of Sprott Asset Management. And I actually had an interview with John about the uranium market a bit over a year ago. I think it was March 2023. So I figured, you know what? I'm going to reach out to John again. We're going to have a similar conversation because the uranium market has been on an utter tear. And I want to get his view to share with you about uranium, about the nuclear industry, and the direction things are heading in. So, John, thank you very much again for joining us and speaking to our readers.
Nice to be back.
Excellent. So let's crack on with this. I want to put it to you that so we had this conversation as I said, about March last year. At the time, the uranium price was around $50. It has since gone on to break 100 earlier this year in 2024. Now, the last time we saw that was, I believe it was sort of early 2007, and it was somewhat of a boom and bust cycle out of that because the price did come right back down in the subsequent years. So let's sort of put the last year into perspective first. We were at $50 a pound a year ago. We've broken through 100. I think we're about in the 90s now as it stands. What has happened in the last year since we spoke that has caused the price of uranium to go from 50 doubled to over 100?
Yeah, no, it's been an incredibly eventful year over the last 12 months. As I reflect on where we were last summer, where we hit a bit of a lull, there was a bit of a dry period in news flow, and then something very interesting happened last August, which is typically a very quiet period in the uranium market, as a lot of the participants kind of take the month of August off for summer. And we started to see the price of uranium break out from kind of the mid 50s per pound through to 60. And from kind of September through to January, as you mentioned, we went on a tear where the price went from kind of 57 and kind of hit a peak of around $106 a pound. That's a pretty big move in a very short period of time. So let's take a step back and say, okay, what was driving that? Well, there was two things really happening. One, what really got things going was I think the World Nuclear Association put out a new forecast in September of last year that clearly is starting to indicate that the demand for uranium going out to 2040 is going to be much higher than everybody initially thought. And this is really because more reactors are being built around the world. There's about 60 being built right now. There's over 100 being planned. And there's a number of plants around the world that are basically scheduled to restart or getting life extensions. And the question is, well, why is all this happening? Well, it's because people are looking for reliable sources of clean energy meaning low or zero greenhouse gas emissions. And that's exactly what nuclear power provides. So you had a number of countries that have really shifted their energy policy and support back to nuclear energy. It's happening right around the world, with the exception of, I'm going to say, Spain and Germany. Most other countries have shifted back. So that's really moved the demand for uranium from current annual usage of around 180 million pounds to estimated from 180 today to, depending on the forecast, somewhere in the 300 to 350 million pounds in the year 2040. So you're talking about an industry that somehow has to figure out how to double in size after it basically shrunk for 10 years. So that's a huge challenge and a huge opportunity. I think the other thing that really got the market going was some announcements from some of the key mining companies around the world that responding to this future demand and the recent price action is not going to be as straightforward as everybody thought it was going to be. We've clearly had some production hiccups from Cameco that they announced and are dealing with last year. We've had a coup in Niger, which we're coming up to almost a year now, and there's no resolution. And it looks as though the French are going to be muscled out of those mining operations that they've been running for a long time. And the rumors are that the Russians are trying to take those over. And then I'd say the last piece of big news that has impacted the market is from Kazakhstan. And why Kazakhstan is so instrumental to this story is they are essentially the OPEC of uranium. They produce over 40% of the world's uranium. And they recently said they were going to increase production in response to this growing demand and higher pricing. And that was at the end of September last year. And then a few months later, they basically walked it all back and said, no, we cannot and will not increase production. And so, why that is so meaningful for investors is simply this. In every commodity cycle, as the price moves higher, it sends a market signal to incentivize higher production.
Yep.
And you would expect that that market signal would translate into low cost producers, stimulating production and to capture that opportunity. So when the world's largest and lowest cost producer signals they do not have the ability or are unwilling to flex up production, that really tells you the bull market will last longer than you think. And a lot of people talk about the 2006-7 period of uranium because it was exciting and the price kind of went parabolic. But I think what we've been messaging to our investors for the last year is this bull market is going to be more similar to the bull market that played out in the 1970s.
Right.
That bull market in uranium was once again prompted by an energy shock. It was OPEC and oil at that time. And what you saw was the price of uranium went up exponentially and stayed high, and not for 1 or 2 quarters or 1 or 2 years. It stayed high for 10 years. And we think that kind of dynamic has to play out here because it's the only way an industry can basically double production. It's the only way the world can build another 150 odd reactors. The whole supply chain needs to basically bulk up. And it's only going to happen with higher prices. And that's the fundamental thesis that we've been talking about for 3 years with our investors.
Yeah, I mean, we're absolutely on the same page with that. This is a story. It's funny because we're talking about effectively the nuclear industry. Nothing happens quickly, does it? So
That's right.
you're looking at the lead time. Even if you might have a great uranium deposit, but the actual time to get that into production, we're talking years. And likewise, the construction of reactors themselves typically takes an extremely long amount of time. Um, if we sort of jump forward a year, so a lot of talk right now comes around. There's obviously, the AI revolution has been a major talking point in markets for investors for the last 18 months, and it's not a story that's going away. The byproduct of that, obviously, is this realization that sort of integration of AI into things like data centers requires an immense amount of energy and power. So the step is that greener, cleaner, more efficient, more energy efficient energy is required to meet these increases in demand, which is obviously in part of why these forecasts have changed. So there's a lot of talk around new nuclear technology like SMRs and companies coming to market in that sense. And then obviously I think it's the US bill, which is I think coming into force in August, which is banning Russian imports in the US of enriched uranium. So do you see over the next year these factors continuing to have a bullish impact on the uranium market and the nuclear industry?
Yeah, absolutely. I mean, you raise a couple of really interesting parts of the story, starting with the Russian uranium ban. This has obviously been 2 years in the making. It was a long, drawn out legislative process to get there. And I was recently on a panel at a conference a few weeks ago, and somebody said, "Well, what do you think it's going to do to the price?" And I said, "Well, the price has been going up for two years in anticipation of this finally happening." So I think it's important to put that into context. But I think the really bigger picture driver here is the U.S. and other countries have finally realized they need to reshore this critical supply chain away from Russia. So if you think about Russia's role in the uranium sector, it's not as a producer, it's as a service provider.
Hmm.
And those services are very important. You take uranium and you mill it to U3O8, and then you convert it into a gas, which they call UF6, and then you enrich that gas through centrifuge process. And Russia controls about 30 and 40% of global capacity in those last two steps. So Western utilities for decades have relied on Russia for 20 to 25% of that last step, which is enriched uranium. So the clock is basically ticking where we have a ban that's coming. Now there's a waiver process for US utilities that will end at the end of 2027. And look, the reality is I think the waiver process is going to function efficiently for probably the next couple of years because there has to be a transition. There is no capacity. What was really important about the bill was it also released almost $3 billion of funding,
Yeah.
and that was basically to incentivize this reshoring of the nuclear fuel supply chain back in the US. So that is money available to basically expand existing facilities, restart existing ones, etc. And that's really important to this reshoring exercise. So uranium is incredibly geopolitically charged, to use that pun, amongst all critical minerals because of where it's produced, who produces it, controls it, and the supply chain. So it's something we watch very carefully. On the AI, I think it's obviously it's a new technology. It's very exciting, but if you take a step back, really, what's driving increased electricity usage is places like China and India that are increasing their consumption of energy per capita relative to the rest of the world.
Mm.
So where I live in Canada, we haven't really, or in the United States for that matter, people haven't really increased their amount of electricity consumption for 20 years. And that's just because engineers are incredibly effective at making things more efficient. So energy or electricity demand has grown by like half of 1% over the last 20 years. But in places like India and other emerging markets, it's going to grow by over 50% in terms of overall consumption over the next 20 odd years.
Mm.
And that's just because as you gain wealth there, you start buying things that are energy intensive, like appliances or air conditioners or cars or whatever. Now, in the West, why everyone is excited is because we've had this backdrop of very benign electricity consumption for 20 years. And the forecasts are starting to signal, hey, we're going to need a whole lot more electricity, and not just any old electricity, clean power, because AI data centers are very energy intensive. So if you look at how much energy, let's say a Google search, some kind of a cloud-based data center for, basic, Google's, data centers or storing information in the cloud, it's incredibly low. When you compare that relative to the amount of electricity you need to run these AI data centers, because of the complexity of the machines and the servers. And so what's happening is these technology companies are going to their local utilities saying, hey, we need a whole lot more clean power. And you can imagine utilities are like, well, we haven't really added any new power for 20 years. We've just changed the mix. And so if you're Microsoft and is trying to be a leader in AI, they've said Chat GBT alone is going to require 10 gigawatts of electricity.
Hmm.
You might say, well, what does that mean, 10 gigawatts? Well, that's enough power to run 7.5 million households. It's enormous. So what they're basically doing is they're taking matters in their own hands. They're not waiting for their sleepy little local utility to try to find 10 gigawatts of power. They're basically financing the construction of clean energy projects with companies like Brookfield Renewables. Obviously, there's a lot of talk about collaborations with small modular reactor companies that would basically build these little mini nuclear reactors right next to these data centers, basically what they call co-location. And what that really does is it gives you security of supply in terms of your energy. And it basically allows you to avoid having to connect into the grid, which can be a huge undertaking in terms of the queue that's been building over the years in terms of projects trying to tap into the transmission lines. So, as I said, these technology companies, they move their product cycles very quickly. If you think about how quickly utilities work, it's the polar opposite in terms of their business models. So I find it very fascinating how these technology companies are basically solving their energy problems on their own. And they're very focused on clean energy
Mm.
because they have very serious net zero targets. So whether that's funding new solar or the development of small modular reactors, I think this is going to be a big theme over the coming decade.
I agree, and it's interesting how it's, a lot of the value accretion in these companies has come off the back of AI, and now they're figuring out, well, we've got these huge, war chests of money. We can actually solve this problem and do it faster than if we go through the more traditional channels of doing it. So I think the acceleration of that sort of thing, in part because they need to figure that problem out for themselves, is kind of a logical outcome to it. So I want to wrap things up. Keep this quite brief. So far, the information has been absolutely outstanding, and I think our readers will benefit hugely from understanding your point of view. I just want to cast the net just a smidge further down the track, and just get a reasonably short view on, is this. And again, I kind of hate this term, but it applies so well. Is this situation, this environment of high uranium prices, the new normal? Are we looking at higher for longer? And you mentioned the demand and supply factors here. There are, plenty of uranium deposits out there. Are they going to come to market in the next 5 to 10 years, or is this really going to be that story out to 2040, where this is what you need to get used to, and this is going to be that multi-decade long bull market?
Yeah, I mean, you raise a lot of really interesting points, and we are very confident and hopeful that a number of uranium mines that have basically been sitting there idle, or deposits that were found 10 years ago, will come online in the next 5, 6, 7, 8 years. And it's critical because if you don't have this fuel, the industry will not be able to build out and deliver against its aspirations. And if you think about uranium, this is a really important point. The demand is completely inelastic, meaning you cannot substitute the fuel, you cannot thrift it. And when the price of uranium hit $100, we had some calls with institutional investors, and they said, "Well, we're at $100. Like, wow, like, what are the utilities going to do? Is there going to be demand destruction?" And the response to that is absolutely not. I mean, you've got this multi-billion-dollar machine running that provides electricity 92.5% of the time. If your fuel cost goes up by double or triple, you are not closing that machine down.
Mm.
And that's because the fuel cost is a very tiny component of the overall operating cost, which is one of the real advantages of nuclear energy. And I often use the example of running a nat gas plant right now. About 70% of the cost to run the plant is the fuel. So if the fuel price doubles or triples, you're beholden to the market. You have to pay up.
Yeah.
If the uranium price doubles or triples, the the cost is only 5% of your overall operating costs. So and you really can't, there's no substitution. You can't really reduce it. So this is the beauty of the density, the energy density of uranium. And this is why the uranium stocks are responding finally. They had a bit of a period where they lagged the commodity price.
Mm.
I find there's kind of a back and forth battle. So for example, the uranium price kind of led the market higher. So over the last 12 months, the uranium price is up around 60%. And the uranium stocks are up about 90%. And the junior uranium stocks are up around 108%. So they finally kind of slingshotted back the commodity prices. The commodity price is really sending the signal to the market. But let's put it in a context. The price right now is at 90 odd dollars a pound. But that is really a good price for financial intermediaries to invest in. That is a good price for existing producers, brownfield productions that have been on care and maintenance coming back online. That's really, a healthy level. But in terms of building new greenfield projects, depending on where you are in the world and types of grades and types of mines, $90 is not going to cut it. So we clearly see the term price where utilities are buying uranium for long-term delivery. We think that price is already at the upper end of $130 right now in terms of price caps.
Right.
And I think that's a good signal to look at where the price is ultimately going. The other thing I like to point out to people is, the price in the last two cycles, if you were to adjust them for basic levels of inflation, in the 1970s, we peaked out about $170 a pound in today's terms.
Mm-hmm.
And in the super cycle of the 2000s, we peaked out at around $200 a pound. And right now we're at 90 bucks. So, our belief is that we need higher prices for longer.
Mm.
We need higher prices from 90 to really incentivize greenfield production, and that the bull market is kind of entering the middle innings, but is far from being over.
Yeah, outstanding stuff. Well, again, thank you, John, very much for joining us. Hope everybody watching gained some valuable insight from our discussion today. Thank you very much for watching. Thanks again, John, for being with us, and we'll see you again soon. Bye for now.
Thanks for having me.